The year was 1609. The Dutch Republic had just achieved something unprecedented. A small nation of 2 million people, half of it reclaimed swampland, had fought the Spanish Empire to a standstill. The 12 Years' Truce gave the Dutch breathing room. They used it to build the financial machinery of global commerce. Amsterdam in 1609 faced a crisis familiar to modern economies. Too many currencies. The Dutch accepted coins from across Europe. Spanish reals, German thalers, English shillings, Venetian ducats. Merchants needed to weigh and assess every payment. Counterfeit coins flooded the market. Clipped coins with shaved edges circulated alongside full-weight originals. Payments between merchants required lengthy negotiations about which coins at which values. The city council identified a pressure point in this chaos. If Amsterdam controlled the conversion and settlement of all these currencies, Amsterdam controlled trade itself. On January 31st, 1609, the Amsterdam Wissel Bank opened its doors. The concept was elegant. Merchants deposited physical coins. The bank weighed them, assessed their metal content, and credited the depositor with bank money in a ledger. This bank money, denominated in bank florins, held stable value. When merchants needed to pay each other, they transferred bank florins between accounts. No physical coins changed hands. The bank charged small fees for deposits and transfers. The founding charter made one promise above all others. The bank would hold all deposited metal in its vaults. It would not lend, it would not invest, it would not speculate. Every bank florin in circulation had metal sitting behind it. The Wissel Bank existed to settle payments, nothing more. This promise made the bank different from every other financial institution in Europe. Italian banks lent deposits and sometimes failed. English goldsmiths issued more receipts than they held gold. Swedish banks experimented with paper money backed by copper plates. Every system involved someone trusting someone else to pay them back later. The Bank of Amsterdam eliminated this trust requirement. You did not need to believe the bank would pay you someday. Your metal sat in the vault right now. The bank served as a secure warehouse, not a financial intermediary. This distinction made Amsterdam the safest place to park wealth in the Western world. The city council enforced usage through regulation. Any bill of exchange over 600 florins had to settle through the bank. This mandate created immediate demand. Merchants needed bank accounts to conduct major transactions. Foreign traders opened accounts to participate in Dutch commerce. The bank grew without advertising because the law required its services. By 1620, the bank held deposits from merchants across Protestant Europe. By 1640, Catholic traders who could not openly deal with the Dutch maintained secret accounts. By 1660, the Bank of Amsterdam had become the settlement layer for global trade. Ships from Asia, Africa, and the Americas funneled goods through Dutch ports. Payment for these goods flowed through Dutch bank accounts. The physical infrastructure of ports and warehouses mattered less than the financial infrastructure of trusted settlement. The bank's ledgers from this period survive in the Amsterdam Municipal Archives. They show methodical German bookkeeping, every deposit recorded, every transfer documented. Regular audits confirmed metal stocks matched account balances. The system worked as promised for decades. Other cities tried to copy the model. Hamburg established a similar bank in 1619. Venice attempted reform of its existing institutions. None achieved Amsterdam's dominance. The Dutch had first-mover advantage in a network business. Merchants already held Amsterdam accounts. Their trading partners needed Amsterdam accounts to pay them. Each new account made all existing accounts more valuable. The network effects concentrated financial power in a single institution. By 1683, the Bank of Amsterdam held deposits worth approximately 17 million florins. The annual trade flowing through Amsterdam exceeded 100 million florins. The bank processed this flow with a staff of fewer than 30 people. The leverage of controlling the payment bottleneck required minimal operational expense. The men running the system understood their position. They controlled the financial infrastructure of a global trading empire. They had engineered the concentration of settlement power in their institution. They were the gatekeepers of European commerce, and sometime in the late 17th century they began breaking their promises. The Dutch East India Company posed problems from its founding in 1602. The VOC, as the Dutch called it, represented the largest commercial enterprise the world had ever seen. At its peak, the company employed over 50,000 people. It maintained private armies and navies. It controlled territory across Asia. It waged wars, signed treaties, and governed populations. This scale required capital, constant capital. Ships took years to complete round trips to Asia. Cargo sat in warehouses awaiting favorable markets. Soldiers and sailors required payment regardless of revenue timing. The VOC operated with permanent cash flow gaps. The company sold shares to raise initial capital. It borrowed from wealthy families. It delayed payments to suppliers. None of these sources provided enough. The VOC needed a lender big enough to cover its perpetual shortfalls and discreet enough to avoid embarrassing questions. The Bank of Amsterdam held exactly the money the VOC required. The bank's vaults contained millions in merchant deposits. This money sat idle, backing ledger entries, generating nothing. Bank officials saw this pile of metal every day. They understood its potential. They also understood their charter prohibited lending. The historical record does not reveal exactly when the first secret loan occurred. Archival research by J.G. Van Dillen, working in the 1930s, traced the practice to the late 1600s. The bank created special accounts called anticipation accounts. These accounts did not appear in public reports. They allowed the VOC and the City of Amsterdam to draw funds against future revenue. The mechanics worked through careful deception. Official bank statements reported total deposits and total metal reserves. These numbers matched satisfying public requirements. But the anticipation accounts existed outside this reporting. Money lent to the VOC came from the same vaults as regular deposits. Yet the bank excluded these loans from its public accounting. Bank officials rationalized this arrangement. The VOC always paid back, eventually. The City of Amsterdam backed the company implicitly. The bank earned interest on funds otherwise sitting idle. No depositor had ever demanded their metal and found it missing. The system worked. Why follow outdated rules designed for less sophisticated times? This reasoning follows a pattern repeated across financial history. Rules designed to prevent catastrophe seem unnecessary during good times. The catastrophe has not happened, so the rules must be excessive. Breaking them slightly produces benefits without apparent costs. Success encourages more rule breaking. The margin of safety shrinks invisibly until crisis strikes, and everyone discovers safety margins existed for reasons. The secret lending grew across the 18th century. Stephen Quinn and William Roberts, working with newly digitized bank records in the 2010s, traced the precise expansion. In 1666, actual metal reserves matched reported obligations. The bank operated as promised. By 1720, reserves had dropped to approximately 80% of deposits. By 1760, reserves covered only 50%. By 1780, the bank held metal for less than 25% of its obligations. Each decline passed without incident. The bank operated normally. Merchants transferred bank florins daily. Foreign traders maintained accounts. The agio, the premium bank money commanded over circulating coins, remained positive. External indicators showed a functioning institution. The structure of the fraud reveals the incentives driving it. Bank officials faced no personal penalty for secret lending. They earned fees from VOC transactions. The city council, which oversaw the bank, also governed the city whose finances depended on VOC success. Separation between bank management, city administration, and company leadership barely existed. The same families controlled all three institutions. They lent to themselves using other people's money. Merchant correspondence from this period shows growing unease among informed insiders. Dutch traders with connections to bank management began shifting deposits to other institutions. English and German merchants noted unusual patterns without understanding their cause. The agio began declining in the 1780s. Bank money, once worth a premium over metal coins, started trading at par, then below par. Sophisticated observers recognized distress signals. Ordinary depositors noticed nothing. The bank's leadership maintained public confidence through opacity. They limited information about vault contents. They assured merchants of institutional soundness. They pointed to 170 years of reliable operation. Trust accumulated over generations, masked rot accumulated over decades. This dynamic defines institutional corruption everywhere. The reputation built by honest predecessors becomes collateral for fraud by their successors. The longer the honest period, the more rope available for later abuse. The Bank of Amsterdam spent a century building trust, then spent a century spending it down. Understanding the Bank of Amsterdam's corruption requires examining the VOC's financial structure. The company operated the most complex logistics network of its era. Ships sailed from Amsterdam to Cape Town to Jakarta to Canton and back. Voyages lasted 2 to 4 years. Cargo moved through dozens of ports. Payments involved multiple currencies, credit instruments, and local customs. The VOC developed financial techniques centuries ahead of its time. It issued the first tradable corporate shares. It maintained sophisticated double-entry accounting across global operations. It created internal transfer pricing between Asian and European divisions. The company invented modern corporate finance through necessity. But invention did not mean stability. The VOC faced structural problems no innovation solved. Asian trade goods sold well in Europe. European trade goods sold poorly in Asia. This imbalance meant the VOC shipped physical silver eastward on every voyage. Asian suppliers wanted metal payment, not European textiles or weapons. The company drained European silver supplies to fund its Asian purchases. This drain created perpetual liquidity problems. Ships departed with silver and returned with goods. The goods sold over months or years. The silver had already left. The company needed financing to bridge this gap. The gap never closed because the trade imbalance never reversed. The Bank of Amsterdam provided this financing through secret arrangements. When VOC directors needed cash for an outbound voyage, they drew from anticipation accounts. When the ships returned, cargo sales eventually replenished these accounts. The cycle repeated for decades. The arrangement worked while Asian trade remained profitable. But profitability declined across the 18th century. English and French competition increased. Asian suppliers demanded better prices. European consumers faced more options. The VOC's margins compressed even as its obligations grew. A healthy institution would have shrunk operations to match declining profitability. The VOC expanded instead. It maintained territorial control, requiring military spending. It paid dividends to shareholders who expected historical returns. It borrowed more to cover gaps between revenue and expenditure. The bank enabled this dysfunction. VOC directors knew they would face no immediate consequences for borrowing. Bank officials approved requests from their social peers and business partners. No external auditor examined consolidated exposure. The extraction machinery operated without friction. Contemporary documents reveal the scale of interconnection. Bank commissioners held VOC directorships. City council members sat on both boards. Marriage ties linked the families controlling all three institutions. When the bank lent to the VOC, it lent to organizations controlled by the same people who ran the bank. Conflicts of interest saturated every decision. This concentration of power mirrors patterns in modern finance. Banks lend to enterprises controlled by their own executives. Corporate boards share members across supposedly competing firms. Regulatory agencies employ industry veterans who return to industry after government service. The Amsterdam system looks corrupt to modern eyes because modern systems obscure similar dynamics more skillfully. The bank's leverage over global trade made its corruption particularly dangerous. Amsterdam remained the settlement hub for international commerce. Merchants held bank accounts because their trading partners held bank accounts. Alternatives existed, but required sacrificing network benefits. Depositors faced switching costs high enough to discourage movement, even as warning signs accumulated. The bank exploited this captive customer base. It paid no interest on deposits while earning interest on secret loans. It charged fees for services while providing declining safety. It profited from the spread between what depositors received and what borrowers paid. The extraction grew larger as the bank's actual soundness grew smaller. By the 1780s, the Bank of Amsterdam had become a hollow institution. Its vaults contained a fraction of required reserves. Its primary borrower faced structural decline. Its management had no plan for crisis beyond hoping crisis would not arrive. The machinery of extraction had consumed its own foundation. The Fourth Anglo-Dutch War began in 1780. England and the Dutch Republic had drifted toward conflict over Dutch support for American independence and continued trade with French colonies. The war went badly for the Dutch from the start. English naval superiority strangled Dutch shipping. VOC vessels faced capture throughout Asian waters. Insurance rates for Dutch cargoes became prohibitive. Trade volume collapsed. The revenue streams funding VOC loan repayments dried up. The Bank of Amsterdam's hidden exposure became acute. The VOC owed millions it could not repay. The city owed additional millions from its own borrowing. Actual metal in the vaults covered less than a quarter of deposit obligations. Any significant withdrawal pressure would expose the fraud. Sophisticated depositors began moving funds. Merchant correspondence from 1780 through 1794 shows growing anxiety among the banking community. Amsterdam traders shifted deposits to Hamburg and London. English merchants closed accounts and demanded metal. The agio collapsed, with bank money trading at steep discounts to coin. These signals warned anyone paying attention. The bank responded with restrictions. It limited metal withdrawals to small amounts. It delayed transfers. It blamed temporary circumstances for what had become permanent dysfunction. Each restriction confirmed depositor fears and accelerated flight. The VOC's situation deteriorated in parallel. The company suspended dividend payments in 1782. It sought government bailouts in 1783. It limped through the following years on emergency financing, while its Asian operations contracted. By 1795, the VOC was functionally bankrupt, waiting for legal dissolution. January 1795 brought the end. French revolutionary armies invaded the Dutch Republic during an unusually cold winter. Rivers that normally protected Dutch borders froze solid. French cavalry rode across the ice. Dutch defenses collapsed within weeks. The Batavian Revolution installed a new government sympathetic to France. One of its first acts was examining the Bank of Amsterdam's actual condition. Investigators opened sealed records. They counted vault contents. They discovered the truth. The bank held approximately 4 million florins in metal. It owed approximately 16 million florins to depositors. The difference had been lent to entities that would never repay. The world's most trusted financial institution was insolvent by any reasonable standard. Publication of these findings destroyed remaining confidence instantly. The agio, already negative, collapsed further. Depositors who had not already fled demanded whatever they could recover. The bank entered a terminal decline lasting years, but functionally ending in weeks. The timing proved catastrophic for Dutch financial credibility. Military defeat alone need not have destroyed the financial system. Countries recover from military losses. But military defeat, combined with exposure of systematic fraud, created a narrative of fundamental Dutch untrustworthiness. If the Bank of Amsterdam had been lying for decades, what else were the Dutch lying about? This reputational collapse mattered more than the actual losses. Physical wealth still existed in Amsterdam. Ships, warehouses, productive enterprises continued operating. But the financial infrastructure of trust evaporated. Merchants who had automatically accepted Dutch payment guarantees began demanding alternatives. The network effects that had concentrated settlement in Amsterdam now concentrated settlement elsewhere. London absorbed this flow. The Bank of England, chartered in 1694, had learned from Amsterdam's example. It maintained clearer separation between bank management and government finance. It faced parliamentary oversight, absent in Amsterdam's city council arrangement. It published more information about its operations. Whether these safeguards would have prevented similar corruption remains uncertain. But the perception of superior governance attracted depositors fleeing Dutch chaos. The years following 1795 witnessed a complete restructuring of global finance. Amsterdam's collapse created a vacuum. London filled it. English financial infrastructure had developed in Amsterdam's shadow for a century. English merchants maintained Amsterdam accounts for international settlement. English banks correspondent banked through Amsterdam for continental transactions. English companies borrowed in Dutch capital markets when domestic credit tightened. London served as Amsterdam's dependent partner in the European financial system. This dependency reversed within a decade. The Bank of England became the new hub for international settlement. London discount houses replaced Amsterdam counting houses as the centers of trade finance. English pounds replaced Dutch guilders as the currency merchants specified in contracts. The switch occurred faster than anyone had predicted because it reflected not gradual migration but sudden flight. The VOC dissolved formally in 1799. The Dutch government nationalized its assets and debts. The territories it had controlled passed to government administration. The commercial enterprise that had driven Dutch financial needs for 2 centuries simply stopped existing. Its debts to the Bank of Amsterdam remained unpaid. The Bank of Amsterdam continued operating in diminished form for another 2 decades. It processed domestic transactions. It maintained accounts for merchants unwilling or unable to relocate, but it never regained international significance. The trust that had made its bank money valuable globally had been demonstrated fraudulent. No recovery was possible. English observers drew explicit lessons from Amsterdam's failure. Parliamentary debates referenced the Dutch example when discussing Bank of England governance. Economists analyzing monetary systems contrasted Amsterdam's secret lending with English transparency. The Bank of Amsterdam became a case study in how not to run a financial institution. These lessons shaped English policy. The Bank of England maintained closer government oversight than Amsterdam had tolerated. It published accounts more frequently. It faced external scrutiny from parliamentary committees. Whether these measures prevented similar corruption or merely postponed it remains debated. The 19th century brought its own English banking crises, but none triggered the catastrophic loss of confidence Amsterdam experienced. The monetary shift reinforced and accelerated existing trends. English industrial production was already surpassing Dutch output by the 1780s. English naval power dominated global shipping lanes. English colonies provided raw materials and captive markets. Financial supremacy added another advantage to these existing strengths. The country, with the manufacturing, military, and financial infrastructure to organize global commerce, did so. The 19th century became the British century. The pound sterling served as the anchor currency for international trade. London banks financed railways, canals, and factories across every continent. English monetary standards, the gold standard formalized in 1821, became the template other nations adopted to join the global system. This architecture traced directly to Amsterdam's collapse and London's absorption of fleeing capital. The Dutch economy recovered eventually. Amsterdam remained a significant financial center within continental Europe. Dutch trading companies operated globally through the 19th and 20th centuries. But the Dutch never regained the monetary supremacy they held in the 17th century. The window for dominance had closed. The infrastructure of trust they had built and then betrayed could not be reconstructed once alternatives existed. Silicon Valley Bank collapsed in March 2023. The mechanics differed from Amsterdam. The outcome echoed precisely. SVB built its reputation on specialized trustworthiness. It served technology companies and their investors. It understood startup cash flows. It provided services traditional banks ignored. Founders and venture capitalists concentrated deposits in an institution that understood their needs. This concentrated deposit base created fragility. Tech companies held enormous cash reserves in SVB accounts. Unlike retail deposits spread across millions of customers, SVB's deposits concentrated among hundreds of large clients. These clients communicated constantly through shared networks. If one founder texted another about concerns, the message spread through the entire ecosystem within hours. SVB's management took risks depositors did not understand. Rising interest rates in 2022 reduced the value of bonds SVB held. Accounting rules allowed the bank to ignore these losses if it held bonds to maturity. But the losses existed. If SVB needed to sell bonds early, it would realize losses that consumed its capital cushion. Depositors remained unaware of this exposure until March 2023. SVB announced it needed to raise capital after selling bonds at a loss. This announcement triggered exactly the bank-run managers had hoped to avoid. Depositors withdrew $42 billion in a single day. The bank failed within 48 hours. The Amsterdam pattern repeated: trusted institution, hidden risk, external shock forcing transparency, immediate collapse. Trust accumulated over years, evaporated in hours once evidence of mismanagement emerged. Modern banking regulations exist specifically to prevent Amsterdam-style fraud. Deposit insurance protects retail customers. Capital requirements force banks to maintain cushions against losses. Disclosure rules mandate transparency about risk exposures. Examination processes allow regulators to inspect internal operations. These safeguards reduce risk without eliminating it. SVB met regulatory capital requirements right up until it failed. Its disclosures technically described its bond portfolio. Its examiners had noted interest rate risk in previous reports. The system functioned as designed and still produced catastrophic failure. The cryptocurrency movement interprets this pattern as evidence against trusted third parties. Bitcoin advocates cite Amsterdam's secret lending as exactly the fraud Satoshi Nakamoto's white paper addressed. If banks always eventually abuse depositor trust, then systems requiring no trust in intermediaries provide superior safety. The Bank of Amsterdam serves as Exhibit A in their case against traditional finance. Traditional bankers counter that Amsterdam's 150 successful years demonstrate institutional banking works. The system failed eventually, but it succeeded for generations. Modern safeguards reduce failure probability further. Perfect safety exists nowhere. Imperfect safety still provides tremendous value. This debate touches your money directly. Your bank deposits rest on the same fundamental promise Amsterdam made. Your funds exist, available on demand, backed by real assets. Modern banks take your deposits and invest them in loans and securities. They keep fractional reserves, far less than 100% of deposits. They trust that not everyone will demand their money simultaneously. The FDIC insures deposits up to $250,000 precisely because this fractional system involves risk. If banks kept all deposits in vaults, insurance would be unnecessary. The existence of insurance programs acknowledges that banks do exactly what Amsterdam did, using deposits for purposes depositors do not control. Your sophistication about this arrangement determines your exposure to Amsterdam-style events. Depositors who understood Amsterdam's deterioration moved funds early. They preserved their wealth. Depositors who trusted institutional reputation lost everything. The same pattern applied at SVB. Informed insiders withdrew early. Late-moving depositors faced frozen accounts and uncertain recoveries. The Bank of Amsterdam's fall reshaped global monetary geography. It transferred financial supremacy from the Netherlands to England. It established London as the center of international finance, a position maintained until the 20th century when New York absorbed that role. It demonstrated that monetary power depends on trust, and trust once broken does not return. You navigate the system daily. You deposit paychecks and trust the numbers are real. You accept digital transfers and trust the senders have funds. You denominate savings in currencies and trust governments maintain their value. Every financial transaction involves faith in institutions you do not control and cannot fully examine. Amsterdam's lesson is not that all institutions fail. It is that institutions fail specifically when the incentives of their managers diverge from the interests of their depositors. Bank officials lent to the VOC because lending benefited them personally while imposing risks on others. They faced no consequences for secret fraud while enjoying benefits from it. The structure of incentives made corruption rational. Modern financial regulation attempts to align incentives better than Amsterdam managed. Executive compensation rules, clawback provisions, personal liability standards all try to make managers care about long-term institutional health. Whether these mechanisms work remains tested by each crisis. SVB's executives sold stock in the weeks before collapse. Their personal incentives remained misaligned with depositor interests despite decades of regulatory development since Amsterdam. The frozen rivers of January 1795 did not destroy the Bank of Amsterdam. The bank destroyed itself through decades of accumulated betrayal. The French invasion merely revealed what insiders already knew. The world's most trusted financial institution had been lying about its most fundamental promise for generations. Your bank makes similar promises today. The vault contains your money. The ledger reflects reality. The institution follows its rules. You trust these promises because functioning economies require functional banks. Amsterdam's depositors trusted for the same reasons. The question is whether the incentive structures governing your bank differ enough from Amsterdam as to produce different results. The officials running the Bank of Amsterdam were not uniquely corrupt. They responded rationally to the incentives they faced. Modern bankers face different incentives. Whether different enough remains the open question every depositor unknowingly answers by where they keep their money. The transfer of financial power from Amsterdam to London shaped the world you inherited. The British Empire ran on London credit. The American Republic financed its growth through London banks. The global trading system of the 19th and 20th centuries used infrastructure London built after Amsterdam's collapse. This is not ancient history. This is the architecture still organizing your financial life. Your mortgage follows standards developed by institutions tracing to post-Amsterdam London. Your retirement savings flow through markets first organized in the City of London. Your currency's value relates to monetary theories refined after Amsterdam proved the cost of monetary fraud. The Bank of Amsterdam, as corruption teaches that systems sold as perfectly safe attract exactly the actors willing to exploit that perception. The safer an institution appears, the more valuable corrupting it becomes. The more trust accumulated, the more trust available for betrayal. Perfect safety sells a promise no human institution keeps forever. Your protection lies not in finding perfectly safe institutions, but in understanding that no institution is perfectly safe. Diversification across banks, across asset classes, across currencies provides resilience Amsterdam's concentrated depositors lacked. Skepticism about promises too good to examine provides protection Amsterdam's trusting merchants surrendered. The Dutch merchants of 1794 believed their bank's promises because believing cost nothing and provided convenience. They learned that unexamined trust costs everything when examined too late. You make similar calculations with every deposit slip and every account balance you accept without investigation. The Bank of Amsterdam stood for 170 years. It processed the commerce of empires. It maintained the monetary infrastructure of global trade. It earned trust across generations of reliable service. Then it revealed that trust had been misplaced for decades, and it vanished in weeks. The men who corrupted it faced no consequences. The depositors who trusted it lost their savings. The nation that hosted it lost its financial empire. The world that depended on it found a new center in London and never looked back. This is the history of wealth. The money moved. The power shifted. The patterns repeat. The question is whether you recognize them before the next frozen river exposes the next hollow vault.